Hi, I'm Adrian Helfert, Director of Multi-Asset for Westwood, and I'm here to present our capital market outlook. We finished a stellar 2019 with a stellar fourth quarter. In essence, we saw equities that were up over the course of the entire year. The difference is in the details, though. What's the difference between the first 3 quarters of the year and the last quarter of the year is what defined the characteristics that we'll see in 2020. The first 3 quarters of 2019, we saw equities going up, while we saw economic growth not necessarily doing anything. We saw interest rates dropping, bond prices going up. Thus, all assets were doing well. In the fourth quarter, interest rates started moving up. That's a proxy for good economic growth and potential inflation growth. At the same time, you can look at other asset classes, things like copper, Dr. Copper as we call it, because it's a good forecaster of economic growth, and see the same thing. Thus, what we start to see is we start to see good potential growth coming into 2020, not just supported from the U.S. Central Bank. We saw this quarter a continuation of the longest cycle in history. In essence, economic growth has been slow and low and continues as such, and that's our expectation, and the cycle can continue further. The virtuous cycle, as we look at it, is still well in place, with wages rising, labor good, consumer sentiment good, consumer purchasing reasonable. If any tick in the armor, it's truly capital expenditure. Now, we did see some positivity this quarter from CFOs. CFO surveys showed that CFOs are now looking further to starting to purchase capital goods for their businesses and for the growth that they see in the environment. That's a very positive signal that we see, and we'd like to see this going forward. The driver of that, we think, was the Phase 1 introduction of the Chinese trade deal. In doing so, CFOs started to see further transparency on a positive economic growth environment. While this is a welcome development, equity performance has really foretold some of this. We did not see another 30% plus equity index year coming into 2020. That said, we are modestly positive, and we do see performance that can do well, with anchored rates, with equity performance that can be modestly up given growth metrics, and with commodity prices doing decently. We like the environment that we're in for a continuation of economic growth. Even with our positive outlook, investors should be thinking more towards an end-of-cycle type of investing. That means they should hold intermediate to long-duration fixed income as part of their portfolio, and within their equity portfolio, income can actually produce pretty good returns given anchored interest rates from the Federal Reserve. And you might actually look at some sectors, like real estate investment trust, with positive housing metrics, with dropping mortgage rates, that could provide not only extra income, but capital appreciation. Previously, I have said we do not expect an imminent recession, and that remains the case. Many of the catalysts that we had in 2019 that could have impacted this, things like Brexit or Italy or central banking activity, have been resolved. In 2020, we have other catalysts, especially the presidential election, for which the outcome could actually change the mindset on that. Otherwise, we see it as an elongated cycle. 2020 has already kicked off with good performance both in equities and bonds. The recent news around the virus from China that's been transmitted is likely to have an impact on Chinese economic growth. Given that China is the #1 contributor to world economic growth, this could have an impact in the future on U.S. growth, for which we'll remain mindful of as an impact on a possible recession risk. We'll keep you updated on this story as it develops. Thank you for your time, and we'll see you soon.